One of the most common questions I hear is what's the biggest mistake people make in real estate? And, it's not necessarily buying at the wrong time. It's not picking the wrong market. It's not even interest rates all the time. The biggest mistake I see people make is they treat their real estate like it's a side hustle instead of using it or treating it like a business. And, the mistakes they show up most clearly when people end up renting out their single family homes or these smaller properties. So let's talk about what happens and when that happens, why it generally destroys returns. So most people, they don't set out to be real estate investors, they move, they keep their old house, they inherit a property, you might buy a rental because someone told them it was easy, and that property becomes kind of an afterthought. And there's no real plan there. There's no underwriting, there's no systems, there's no margin for error, and just definitely there's no experience. So these accidental landlords, they often make emotional decisions instead of these business decisions, and they have no idea if they're in a cash flow state. They have no idea how to add value. They have no idea how to manage the management company. And so owning a property, it does not automatically make it a good investment. That's something that needs to be heard and shared and talked about right out of the gate. Just because you own a piece of real estate doesn't necessarily mean it's cash flowing. It doesn't necessarily mean it's going to go up in value. There's a lot more to that. So many people, they're focused on the purchase price, maybe the rent amount, hopefully appreciation someday, but they ignore operating expenses. They may ignore the CapEx or deferred maintenance. They don't know about vacancy. They don't know about management. They don't know how to handle risk and set the debt up accurately. So they assume as long as the rent covers the mortgage, I'm fine. And the reality with that is the cash flow does not equal profit then. Appreciation is not guaranteed. One major repair each year can completely wipe out your cash flow or potentially years of return. So where renting out a home goes wrong generally is underestimating expenses, or not knowing those expenses. Heck, I made that mistake on one of the first assets I ever bought. In my underwriting, I completely missed the cost of trash, or you'll see people miss the cost of maintenance or turnover costs. When a resident leaves, you got to clean it up, you got to fix it up. And if you don't have a large enough damage deposit, that's coming out of your cash flow or your time. People are often missing CapEx when it comes to the roofs, HVAC, plumbing, depending on the year of the property. If you got a property that's built before 1985, you may have old plumbing that will be needed to be completely replaced, replumbed, and it is expensive and it takes a lot of time. A lot of people are missing insurance and taxes and what the projections are for the next 3, 5, 7 years. And then obviously property management, even self-management has a cost, you guys. A lot of people will think I'm going to go manage this deal on my own and I'm going to save the 5, 7, 8% of the income and I'll keep it. When in reality, if you're not efficient at managing, not only are you burning your time, but you're probably not leasing at the velocity and speed you need to and getting turns rent ready. So at the end of the day, you still might be losing. The other one that needs to be talked about is reserves. Many owners, they operate with little or no cash buffer. And we're entering a time, ladies and gentlemen, with where we are in the US and where we are in real estate, that you've got to have cash as your buffer. That's your oxygen. Again, one bad tenant or one major repair, it can create panic. You can create this feeling of, I got to fill this property with cash. I got to take it from my personal bank account. And that is not the place you want to be. The other thing is over concentration of risk. If you have one property or if you have one tenant, one income stream, if it goes wrong, everything goes wrong. So, single family, you can have families move out. Things don't go well for that family. And all of a sudden you show up to collect rent and there was no notice. They just skipped in the middle of the night. That can happen. If you're doing a triple net lease deal and you've got a corporately backed lease by a major company, ideally hundreds and hundreds of locations, you've got a lot more ammo than, say, a single family home or even a multifamily deal. If you got 100 leases or 150 units, if you have 3 or 4 or 5 skip out when things get tough, it's not nearly as big of a deal. So just be aware on that one income stream. And if it goes wrong, what are you going to do and how long can you survive with the added cost of getting that unit rent ready to continue to get cash flow back in the deal? And then another thing worth talking about is just emotional decision making. If you don't manage these properties on the day-to-day, or if you don't have a management team, you may hesitate on raising rents. You may get to know these people. And if you hesitate on raising rents and the market is up, you're just missing extra cash flow, or you may be avoiding necessary repairs. I know this needs to get done, but I'm strapped on cash, and that deferred maintenance ends up showing up in the months and years to come, and it affects your ability to rent the unit for top dollar. And then lastly, it's just choosing tenants emotionally instead of objectively. A big part of hiring professional management or being a professional management company is very clearly setting your criteria and how to select a yes or no to residents. And it's one of the biggest decisions you're going to make over and over again, because that resident is either going to pay your rent on time, they're either going to take care of the property, or they're going to end up not paying rent on time and damaging the property. And it's the separator between success or failure. One key line that's worth mentioning, you guys, is one property does not forgive mistakes the way a portfolio does. So just keep in mind that, I hear a lot of people say, well, I only want to have one property. If you can manage that one property and that's all you do, totally different story. Or if you got plenty of time to do it, manage that property really well, or you got some experience, totally different story. But if you're working a job 40 hours a week, 50 hours a week, and you're doing management on the side and it's a side hustle. I was just on with an investor today. He owns a property in Vermont, and he said, Dan, the biggest piece for me is it's just a headache. It's across the country. He's managing this deal. He works a full-time job, and it's just not worth the pain that he's dealing with. So just keep that point in mind. And so why missing underwriting hurts more in today's environment, you guys, is that insurance costs, they're higher across the board. We're seeing major influxes and changes in the weather patterns, and it is affecting assets, and it is affecting insurance costs. And I can tell you that firsthand. Repairs are more expensive. With inflation, yeah, it's nice that rents go up, but your repair cost goes up as well. Payroll costs more for the repairs, the product costs more, property taxes are rising. They're rising tremendously. As they continue to inflate the dollar away and values rise, property taxes are rising as well. You want to have a phenomenal team member on your team that are reviewing your property tax increases each year. You can hire great local firms that only get paid when they win. So what that might look like is, if you get a property tax bill in the mail from the assessor's office with an increase, a certain level of increase, that team member on your team will go and find like properties and legally go and battle that increase and get you a very large reduction sometimes. For us, it can be extremely large. And then their income is 15% of what they reduce. So we only pay when they win, and they're very heavily incentivized to get that tax bill down as much as humanly possible. Interest rates exposed thin margins. You guys, as you can see, people who got into these bridge loans, when those interest rates rose, it showed that there wasn't a lot of extra cash flow, and interest rates rose very aggressively. So be dang clear when you get into your deal. Are you putting in a 5-year, 7-year, 10-year note? Does it align with your CapEx plan? Does it align with where you are in the market cycle for real estate? Knowing market cycles is absolutely critical. It is your holy grail on about where you are and what you're able to do for how much time you have before an exit should likely happen, or a refi into fixed debt. Real estate today, you guys, it just demands discipline. It demands a level of focus. It's going to take your time. It's going to take effort. It's going to take knowledge. And sloppy ownership, it gets exposed in these tougher cycles. And we're seeing that firsthand right now. And it's honestly creating this unique opportunity of buying for those that are prepared, for those that are dialed in, for those that have professionals on their team. So I wanted to go into a section here of how professional investors think differently. And, the difference is that they treat real estate like a business. They underwrite conservatively. They know what to underwrite for vacancy. They know what repairs cost. They know what downturned units cost. They know what a downturn in the cycle is going to do to their underwriting and where they are about in the real estate cycle. They're going to be using systems that are going to be professional management in place, or a professional management company that they own. They're going to have excess reserves. And I'm talking large excess reserves on some of these assets, especially if they're older. They're going to be making data-driven decisions. It's not about emotion. It's purely about what is the data telling us right now. And there is data everywhere. And there is some that's good. There's some that's bad. There's some that's great. And you've got to be tuned into the great data on a week-by-week basis as you are analyzing your portfolio of what you currently own and looking at future product or properties that you want to buy. Professional investors, they're going to diversify. They're going to have multiple units. They're going to have multiple tenants, multiple income streams when it comes to apartments. The multiple tenant piece, I can't stress enough, in the sense that once you hit 100, 150, 200 units, you're going to have some vacancy, And that vacancy is something that will always be something a team is striving to collapse. You're wanting as an owner to get the highest rent and to keep your units vacant for as little time as possible. And the more efficient you are at attracting the great residents, great tenants, providing great service, getting your turns turned faster, and keeping your units full is going to dictate how much income you have at the end of the month. It seems obvious, but it takes more time and more effort to go do. Our philosophy here, you guys, is just focus on durability, not just upside. Buy assets that are in great locations. Get to know your resident profile at a deep level. One of the biggest lessons we've been taught over the last 4 years as we went through a large multifamily real estate cycle is that certain asset classes perform very well and certain asset classes got hammered hard. And the bottom line for us is the newer, nicer locations held on, particularly our B-class deals. A lot of our C-class deals had a lot of pain because those residents went through a lot of pain and are seeing a lot of pain. ICE is disruptive. A lot of challenges with work when the construction slows down. In our A-class properties, our newest deals may have a lot of competition that was started in 2021 and 2022, and those new units have oversupplied the market. And so you've got some of those properties that are struggling for vacancy or occupancy, and they're struggling to maintain rent. So, those B-class assets are really weatherproof nicely. You've got a lot of people that come down. You've got some people that may come up, and it's just that middle ground that feels a bit more recession-proof, if you will. Another thing is the structured deals. You guys got to structure deals to survive bad years, not just good ones. And what that means is projecting 5, 7, or 10 years out and being able to weather what's coming based on, again, where you are about in the market cycle. If we are looking at the real estate cycle here in the US and we can see that the peak based off of the 18.75-year rhythm was right around 21 and 22, and you see pricing going ballistic, probably a pretty good sign to either exit or refi and hunker down, because it's very likely that there's a storm of brewing. And now with where we've gone through, you go through 4 years of pain and cost basis is way cheaper, or price is way cheaper. And you can see that the supply that's coming is not nearly what once was. So rents are going to have pressure. Occupancy is going to have pressure, and you have these deals being traded for a much lower price. It's very likely that you're in a period of a buying window opportunity. And so getting your deals structured to survive bad years and then ride the good years is incredibly critical. Something I just want to run through a few minutes here: single family rentals versus multifamily, because you got a lot of people that reach out talking about their single family rentals. And the piece I would say with single family rentals is usually it's pretty high volatility, and usually a lot of tenant turnover hits hard with single family rentals. Whereas with multifamily, the risk is spread across more units. You can still struggle if you're in a tough location. No question about that. But vacancy just doesn't destroy cash flow as quickly on multifamily as it does on single family. It still can happen, but it's a very different scenario, a very different system. And lastly is the systems and scale. It matters. Scale doesn't eliminate risk. It just absorbs it if you're buying right, if you're managing well, if you're in strong markets. What investors should do instead, from my perspective, is ask yourself a few questions before you get into it. Is this business or is it a hobby? Can I survive a bad year? And if so, why? And what does that look like in my underwriting? Do I have reserves? If so, how much? And what will it look like if we do have tough years? How quickly will I drain it? Am I diversified into different markets, potentially different asset classes? And you really want to focus on cash flow, because when things go haywire and you've got cash flow, time is not pressure for you. You don't mind. Time is something that you can handle. The time when people have to sell, when they're forced to sell in these down markets, usually is due to debt, usually is due to being over leveraged, usually is due to not having enough reserves on hand. And you need to just focus on risk management with that. And if you don't know what that means when I'm talking about risk management, you likely don't have the experience yet. It doesn't mean you shouldn't buy. It just means you need more education. So keep tuned in here and reach out and let us know what you want us to specifically be speaking about more. And if you don't want to operate, you got to partner with disciplined operators. You can invest passively. You can avoid the accidental landlording experience that I'm talking about, and go for a ride with folks who are obsessively doing this and are focused on it every single day. Again, the biggest mistake I see in real estate, it isn't necessarily timing. It's lack of structure. Not having your deal structured properly It does comes down to debt, comes down to underwriting, comes down to management, and just treating a rental like it's a side hustle. It leads to stress, leads to volatility, generally leads to disappointment. And treating it like a business, it can create very predictable and long-term wealth. Real estate rewards discipline and it punishes casual ownership.